Okay, perfect. So we'll go ahead and get started, everyone. Thank you for coming to our workshop. Cindy has hosted 2 workshops already that lots of students enjoyed. So we went ahead and got her to come to host another workshop, and this one's investing. So I'll go ahead and pass it to Cindy.
Awesome. Well, thanks so much, Rebecca. And hi, everyone. So I'm really excited and also thankful to all of you for inviting me for this third powwow of learning all about money. And today specifically, we're going to talk about investing. We're going to talk about really the key to growing your wealth. So as with my other presentations, I'm going to leave in the chat a link to the Google Doc that I'd like for all of you to download a copy of on your personal, your personal computers. Make sure that you open it and make a copy of it. Download the copy to your computers because you want to make sure that you're not working in the document that I sent, because everyone has access to that, right? You want to work on your own personal document. And that document is going to be really critical for this investing journey that you're going to start very soon on, right? If you haven't already. And even if you've already started on the investing journey, I think this is going to be a really great resource for you on, just questions to ask yourself when it comes to investing, how to lay out an investing goal, which we're going to go through together. Like we're going to actually go through this together. But I think that even beyond today, I want you to use this as a resource. Of course, I included a budget template in there. I'm sure, in the past 2 workbooks, we've included a budget template, but I hope that this just reinforces how important the budget is. So I've included that. And then finally, I've included on the last tab of that workbook, some of my favorite resources when it comes to investing. So I'm going to go ahead and share my screen because today's presentation is going to be a little more interactive than our past 2. Our presentations have been jam-packed with information, and investing is honestly probably one of the most challenging workshops to do because there is so much information. So I really tried to distill it to just the simple principles and concepts that you need to know in order to be an educated investor. But then what we're going to do is, I really want this presentation to probably be about an hour. And then we're actually going to run through some examples together. We're going to plug in numbers. I'm going to show you how to use an investing calculator so that you can determine, for your own journey, what should you be in, how much you should be investing, right? For your specific journey. And then of course, as with the other presentations, the last 30 minutes will be solely dedicated to Q&A. Okay. And as with the last presentations, I want to encourage you all to ask questions, right? That's the only way that we're going to progress. And if you have any questions that you think of throughout the presentation that maybe you don't want to share publicly, feel free to just personal, private message me through the chat here on Zoom. And I will, of course, read your question out loud. I will not identify you and I'll answer it. Okay. So let's dive in. We have a lot of information to cover tonight. So welcome to the investing workshop, Grow Your Wealth. So in case you didn't attend the past 2 presentations, I am Cindy Zuniga-Sanchez, the founder of Zero-Based Budget Coaching LLC, a personal finance education platform. And I want to start this presentation by giving a nice big disclaimer, okay? Because I am a full-time commercial litigation attorney as well as an entrepreneur. And the attorney side of me compels me to give this disclaimer. So the information in this presentation that I'm covering with you all today and the information that's in the workbook is not financial advice, okay? This information is only for educational purposes. I am not a financial advisor. I am not a certified financial planner. What that means is that I'm not a financial advisor that's looking at your specific numbers and giving you specific financial or investment advice, right? That is not my job here. All I'm doing is providing just educational information for you. So this information does not constitute legal or tax advice, even though, yes, I'm an attorney. I am not doing any of this in my capacity as an attorney. If you would like to receive individualized investment or legal or tax advice, I recommend that you all reach out to an appropriate professional. Okay, so that is my disclaimer. And now that we have that out the way, I want to share this quote that I really love. And I always think about it. And anytime a client comes to me and says, Cindy, I want to invest, like, when should I start? The best time to invest, no matter how old you are, was yesterday. The second best time is today. And you're going to understand why I'm saying this, because I don't care whether you're 18 years old, 22, 30, 40, you should be investing now. Okay. And we're going to talk about exactly why. But first, let's take it back to basics. Let's just go very basic. What is investing? Okay. Investing is when you put money or another resource that you have into something. It can be a company, it can be a project, an idea, and your expectation is that that resource that you put in is going to grow because of that act that you did. Okay. And when you grow something, when you have that expectation, that means you get profit, right? That's what it is. That's why we invest. Like sometimes people think like, if you ask someone, why do you want to invest? They feel like they need to give you a complicated, very philosophical response. But the truth is that you invest to make more money, period, right? You invest to make more money. That's why people want to buy real estate. That's why people want to invest in the stock market. That's why people are trying to invest in Bitcoin and all these hot cryptocurrencies that are kind of coming up, right? And they feel like they're behind, and it's because they want to make more money. However, something I want to caution all of you is that sometimes when I ask people, why don't you invest? They say, well, I don't want to lose all of my money. Some people say, well, I don't like to gamble. Other people say, that's just not for me. Well, first of all, investing is not gambling. Investing is having a calculated, well thought out strategy to growing your money. That's what investing is. So before we go into defining what the stock market is and all of that, we need to discuss compound interest, because this is the reason why money grows in an investment. This compound interest. Okay. So what is compound interest? Compound interest is the interest that's calculated on a deposit or a loan. Okay. So not just investment, but it could also be on debt. And that interest accumulates on that principal amount. And then more interest accumulates on past principal and interest. So compound interest is basically interest that's growing on top of interest, that's growing on top of interest. All right. So let's walk through an example to make sure that we're all on the same page. So most of you probably have a savings account at the bank, right? Which is great. Bank accounts now are not offering as high of an interest, but I'd say that in a pretty okay time, banks were giving something like 1% interest. So let's look at the slide that's in front of you of 1%. Let's say I decide to deposit $1,000, right? Let's say I got, I don't know, like a birthday gift or a check from a family member or whatever it is, from my job, the tax refund, the stimulus check, whatever it is, I got $1,000. And I said, I want to save that money. So I put that in the bank. The bank tells me, well, Cindy, we're going to give you 1% interest on your money. And I say, oh, that's fabulous. That's great. So check it out. So the first line there is initial deposit $1,000. That's how much I put in, right? The next one is I say, you know what I'm going to put $100 into this bank account every month. I'm going to do that every month. I'm going to just put it $100. And I'm going to do that for 10 years, right? So look at the third box, 10 years. And the bank is going to give me 1% on that money. If I do that at the end of 10 years, I will have $13,731. Now, let's take a step back. If I, and I'm going to take out my calculator, right? Because this involves a little bit of math. I promise it's pretty simple math, right? If I had just put that under my mattress, pretend no compound interest, zero compound interest. If I had just put that money in my mattress, okay? If some of you are really good at math, feel free to comment in the chat box how much I would have at the end of 10 years if I just put that under my mattress. But I'm going to walk you through the math, okay? Now, $100 a month, okay, times 10 years, that's 120 months, right, is $12,000. Simple, right? Super easy. $100 under my mattress for 10 years is $12,000 plus the $1,000 that I already had originally. That's $13,000. Do you see that all? $13,000. So if I had put that money under my mattress, I would have at the end of 10 years, $13,000. However, I put it in a bank account with a 1% interest. So instead of $13,000, I get $13,731. Why? Compound interest. It's a little bit of a profit that the bank is giving me that grows more and more over time. But why do we invest? Because you see, this is what like a bank account will do for you. But some bank accounts don't even do that. Some of them don't even do 1%. Some of them are at like 0.5%. Like my banks right now are at 0.5%. That's why we invest. Because what happens when you invest? When you invest, your money grows. It actually grows. Not by just a couple $100s. No, your money can grow potentially to $1 million. And I'm going to show you exactly how a 22-year-old could retire a millionaire. I'm going to show you that. We're going to do the math. We're going to run down. We're going to do examples. Okay. But before we get there, if we invested instead, if I had instead decided to invest that money, remember I told you guys the $1,000 from the paycheck that I got, right? Let's just call it from the stimulus check. And I'm not saying that you should necessarily invest your stimulus check. No, I'm not saying that at all. But let's just say for me, for my example, let's just say that that's what I decided to do. And I decide instead to invest in the stock market. And I do $100 a month. The stock market, and we're going to go through this a little later, on average, the interest rate that the stock market will give you is about 7 to 12%. 7 to 12%. Okay. So I'm using the number 8. I'm using 8%. Some people might be like, well, Cindy, why didn't you use something like 12%? Right? Well, it's because I'm being very conservative. Right? So I'm going to use a smaller number. And so I plugged into this calculator 8%, because this is what my money looks like when it's invested. And instead of the $13,700 that my money made at the end of 10 years, my money grew to over $20,000. This green that you see right here, guys, on the slide, that represents interest. But do you compare the interest after year 1, this little tiny amount, with after the end of year 10? Compound interest is the reason why investing works. And we're going to go more into this, okay? But I need you to understand, first of all, okay, what's investing? You want to make a profit. But how is it that your money grows? Like, what is it that makes your money grow? Compound interest. It's interest that, look, check this out. It's interest that had grown on interest on top of past interest to make this big, beautiful part of the green graph that you see right here. All right. So let's take it slow. Let's go through some definitions. Okay. What is a stock? Okay. What's a stock? People say, oh, I'm going to invest in stocks. What the hell does that mean? Right? Like what is investing in a stock? Guys, all a stock is a piece of a company. It's partial ownership in a company. It's equity. What is equity? Ownership. So if I were to tell you I own a stock of Facebook, That means I own a piece of Facebook. Now, I probably own a very, very tiny piece of Facebook, right? But I own a piece of Facebook. When Facebook performs well, the value of my stock increases. When Facebook performs poorly, the value of my stock decreases. Okay, so that's a stock. What about a bond? You hear that a lot too, right? A bond. What does that mean? A bond is actually like an IOU. It's basically when you're lending money. So if, for example, I issued a bond to Facebook instead, that means that I've lent them money. Not that I own a piece of their company. That's very different. Stocks and bonds are very, very different. Okay. One is you own a piece of the company. The other one is you are lending money to the company. Okay. And then the last one is very simple, which you all know, which is cash and cash equivalents, right? Cash, I mean, you know what cash is, cash money, right? It's what's in your bank account. It's what's in your wallet. There's also different types of like cash equivalents, which are, for example, CDs. You may have heard of those. Those are certificates of deposits. All that is money that is essentially frozen in your bank account, in a savings account. And in exchange for you having your money frozen, you get a little bit more of interest on that money. That's basically what it is. Okay. For purposes of what we're really diving into today, I really want you all to understand that a stock is when you own a piece of a company, and a bond is when you are lending money to a company, to the government, I mean, you can issue bonds to many different types of players, okay? But they're very, very different. All right, so what's the stock market? The stock market is where all the activity happens. It's where all the action happens. It's where these stocks that you've bought, these pieces of companies, they're traded, they're purchased, they're sold, they're issued. It's just basically, think of it as like, you know, when you think of Wall Street and all this activity and, oh, the price is going low, sell, or buy now, or no, don't do, you know, that's the stock market. It's where all of the activity happens, okay? And now, what's your investment portfolio? I want you to think of your investment portfolio like those expanding folders. You guys know what I mean, right? Like you can have an expanding folder and have, you know, each slot has something for your different subjects, right? Your portfolio is your collection of investments, and you want that collection to work together. So you want to have some stocks, you want to have some bonds, you want to have maybe some real estate in the future, right? You want to have a little bit of something, a little bit of everything, right? And the reason is because when you have something that's balanced, it means that you're not putting all your eggs in one basket. For example, some people right now, they're really attracted to like the cryptocurrency stuff, right? We're not going to focus a lot on cryptocurrency because this investing workshop is really meant to teach you long-term, safe, realistic goals. Now, am I saying don't invest in cryptocurrency? No, absolutely not. But would I put all of your money in that? Like, would I say, oh, if you have $1,000, put all your $1,000 into cryptocurrency? No, because I think that's really, really, really risky. Now, of course, you can do as you please, but I like this idea of having a balance, which is why your investment portfolio should be nicely balanced. Okay. So again, some more definitions. Active investing. This is what a lot of people think all investing is, but I'm going to tell you that I'm not an active investor, but I want to show you what an active investor is. An active investor is someone that basically trades individual stocks, right? So you'll hear like, oh yeah, I sold 20 shares of Facebook and I made this profit. And then I bought some shares of Microsoft, and that's trading. Okay. It's a type of investing, but it's active investing. Now, is there anything bad for it? For active trading? No, it's not a bad thing. It's just a different strategy. When you do active trading, that means that you have a short-term strategy. You want to make money quick. You want to make money now. Okay. It's quick. It's a quick active strategy. And you can have a lot of great profits from this. There are a lot of day traders is what they're called, right? There are a lot of day traders that make a lot of money, guys, a lot. But there are also a lot that lose a lot of money. I mean, thousands and thousands in one day easily. They can also make that too, but you don't usually hear the stories about the people that lost, right? You hear about the stories about the people that won, and that makes you want to be a part of it, right? But before you consider active investing, before you, like, so many people say, well, Cindy, what stock should I buy? Should I buy like a stock of Starbucks or Google? And the real question is, how much do you know about that specific company? If you want to buy specifically stocks, remember guys what stocks is, right? Part ownership of a company. If you want to do that, that's great. But how much do you know about the company? Because you see, a good active investor understands what they're investing in. They understand the company. They understand the company's financials. They understand what the 10K is, the 8K. They understand their annual reports. They understand this information. Why? Because when you understand that information on a company, you're more educated to actually buy or sell an investment. Now, I know what a lot of you are thinking. A lot of you are probably like, whoa, Cindy, like, I don't want to do that. Like, that's a lot of work. Like, you want me to research every company and read those complicated financial statements? You don't have to. This is what I do. I'm not an active investor. I do not do active investing. There's nothing wrong with that. There's nothing wrong with active investing. But personally, as I told you guys earlier, I'm a full-time lawyer. I'm also an entrepreneur. Okay. I don't have time to research all these companies. So I personally do passive investing. What is passive investing? Passive investing is exactly what it sounds like. It's basically like you kind of take a step back, sit back, relax, and you let your investments work for you. So I know a lot of you are thinking like, wait, what? Like, you can do that? How? You can, but you need a long-term strategy. If you want to do that, you can't want to make money, like a bunch of money tomorrow, right away. And I know that's attractive, guys. I know it is, right? Trust me, if I had the key to like what stock is gonna, if I had a crystal ball that said this is the stock that's gonna perform crazy well tomorrow, I'd be like, hey, let me go for that. But I don't. No, nobody has a crystal ball. Nobody knows what stocks are gonna do or not. And so I have a very long-term strategy. My strategy of passive investing means that I'm not selling and buying my stocks and my bonds constantly. I'm not doing that. I'm kind of taking a step back instead. Okay, because I'm a passive investor. Now, a con that a lot of people say is, well, but Cindy, that means that your returns are like average, right? Remember, the return, that's like the profit. That's like average. And, you know, I don't really want to be average. Like, I want to make more. But I'm going to show you guys later that maybe it's okay to be average. Maybe it's not a crime, right? Maybe it's not the worst thing to just have average returns from a long-term strategy. Okay. So again, some more definitions, right? A lot of investing is just understanding these definitions. And if you guys have questions on any of these definitions, you need me to repeat something, you know, feel free to leave it in the chat. Also in the Q&A, we'll be talking about this, right? Because it's important for us to understand these terms, right? So now we're going to talk about the different types of investments. Like, okay, Cindy, I want to get started in investing. Like, what should I buy? What should I get? Now, you can get an individual stock. We kind of went over this already, right? It's a share, a stock equals share, right? In a single company. So for example, Facebook, Google, or maybe you really like luxury goods. So LVMH, right? That's like Louis Vuitton, Moet Hennessy. That's the parent company of like a lot of the Louis Vuitton brands and, alcohol, companies as well. So it's like luxury goods basically. So maybe you decided you want to buy a single stock in one of those companies. Now, what's the plus? What's the pro? You can make a lot of money. If you pick the right company, you can make a lot of money. But you can also lose a lot of money because it's very unpredictable. Nobody knows how these companies are going to perform. And it might take a lot of time, right? Because I already told you guys, I kind of want you to research these companies. If you're going to invest in these companies, if you're going to say, you know what, I'm going to buy a piece of Facebook, I want you to understand, like, is Facebook maybe coming out with some new technology that could really increase the value of their stock? Or are they facing a lot of lawsuits from the federal government, which could bring the value of their stocks down? These are questions that a good investor that's buying stocks from individual companies should understand. There's also something called a mutual fund, right? So what's a mutual fund? I want you to think of it this way. A mutual fund is basically kind of like a basket of a bunch of different types of stocks in one. So think of it this way. A single stock is a rose. A mutual fund is a bouquet, different types of flowers. Okay, so again, a stock is a rose. I got you one rose, I got you one stock. You say, I don't really just want that. I want a little bit of everything. Okay, so then I'm going to give you a mutual fund. I'm going to give you a bouquet. And the bouquet is going to have roses and lilies and peonies, and they're going to have a bunch of different flowers in them. Okay, they're also going to have some baby's breath, which is not as expensive, some greenery, which is also not as expensive, but the roses are really expensive. So it's going to have a mix. Each of those flowers or plants or greenery represents a company. Some of them are really high value, some of them are not so high value. But together they just work. Now, why do we like a mutual fund? Well, because diversification, right? Diversification. Now, all of a sudden, what if the rose dies? What if Facebook dies? Well, you have all these other flowers that are still working for you. They're still working in the stock market. So now all is lost. So that's a pro. Now, a con is some mutual funds are actively managed. That means that a financial advisor is actively managing that mutual fund. They are there and they are like, someone needs to do it, right? Someone needs to say, you know what? I want to sell this one and this company and I want to buy this one. Like, you need to pay someone to do that. So what happens is that if you pay someone to manage your investments, it means less profit for you, right? Because you're paying someone to do that for you. Now, if you want to become the trader and the person that's doing all of this, right? People do that, right? But that's like a whole profession. That's like a whole career path. That's a whole job right there. And that's why financial advisors, investment analysts, they do this kind of work. But you have to pay for it. What if you don't want to do that? What if you just like, Cindy, like, I don't want to have to pay someone a lot of money to do this because, like, as it is, I don't have a ton of money to invest. I want to keep as much as possible. So what can I do? This is the index fund. The index fund is a beautiful thing. Why do I love the index fund? It's a type of mutual fund. It is, because it's a type of bouquet. But you don't have someone like think of the fund manager as like an expensive florist. You know, the expensive florist can be, hey, their job is wonderful and all, but they can be expensive. I want you to think of the person managing the index fund is actually a robot. It's computers, it's algorithms. It's not a person, it's an algorithm. It's a computer. And when a computer is managing your beautiful bouquet, it's cheaper. It's cheaper, which means that you're not paying that kind of really high fee. Now, what's the con? Again, I told you guys earlier, these index funds, they're not super risky. They're not. They're pretty conservative. And so because of that, you should expect about an average return. So you're not going to get the kind of returns that maybe if you got someone that, they just knew the hot tip for the stock market and they just made the right sale at the right time for your mutual funds, you're going to get something a little bit more average because it's all managed by computers. Index funds are managed by computers. So let's go through it, because the index fund is such a beautiful thing and I'm such a fan that I want to make sure that we understand exactly what it is, okay? An index is basically something that measures the performance of companies. Okay, it's a number. Look at the number on the screen that measures a performance of a company. There are many different types of indices. Okay, this index specifically is the S&P 500. What is the S&P 500, everyone? Okay, the S&P 500 are the top 500 companies in the United States. So you have here, you got Amazon, you got Google, you got Microsoft, you got Facebook, you got LVMH, you got some of the most powerful companies in America. The 500, you have Johnson & Johnson, you have the 500 top companies in the United States. They are part of this index. They are part of this group. Think of it as a club. I think that's a great way to think about it. Think of it as a club. So we're going to call this club the S&P 500 club. All right, cool. So how is this club performing? All right, well, let's look at it. All right, everybody that's on this Zoom right now, let's look at how is this club, right? This cool group, how are they performing? Well, they're performing pretty well. Look at how they were back in, it doesn't quite say it with a little cursor, but back in March of 2020, right? When the stock market, like everything, I mean, you guys remember, right? Everything went down with the economy, in March 2020. You see there that the amount, right? Their value, their worth was about 2,250. You see that, right? But look at a year later, guys. Look at where it was in March 12th, 2021. Look at the value of that club, of this club of the S&P 500. Their value increased to nearly 4,000. That's the value that's been given to them. So you see it's growing, which means they're doing pretty well. And that's because the economy has done much better since that dip back in March of 2020. So you're like, all right, Cindy, what I'm looking at right now is something called the index for the S&P 500, right? And I say, yes. Okay, the index is basically a club of like cool kids. Yes, exactly. Good. Okay, so how do I know what club this is? Well, look at the top right here. Look at where my mouse is. This is the club S&P 500. And you're like, all right, cool. They're doing pretty well. How do I get a piece of that? Like, how do I buy a piece of that, Cindy? Like, that's pretty good. Like, I want a piece of them. That's this. This is a specific investment, guys. A specific investment that you can buy. I'm not saying to buy it. I'm just saying that if you wanted a piece of the cool kids, the S&P 500, that's just one type of index. There are so many types of indices, okay? But this is one type. If you wanted a piece of this one, this is what it's called, VOO. Do you see this? VOO. It is the Vanguard 500 Index Fund, ETF. And I know that's a lot of words, right? But all it is that if you wanted a piece, let's just say Rebecca was like, Cindy, I want a piece of the S&P 500. And I just found out that VOO, that this thing right here, and I'm going to show you guys if you're interested in like kind of, in buying all of these, like kind of where you can do that. And I'm also going to show you like, what if you don't want to like guess like which one you should buy? I'm also going to show you what an option for you guys, a very easy option. But basically, if you buy a piece of this, if you buy VOO, it's going to cost you $362. $362 to buy a piece of the Cool Kids Club. But last year, look at down here, look at in March 2020, the value of that was about $200. A year later, it's over. The profit on one piece of that pie grew to over $360. That's how the stock market works, guys. It's all based on how the companies are performing. If they're doing well, your investments are going to go up. If they're doing bad, your investments are going to go down. That's how the stock market works. Okay. So you're like, all right, Cindy, I want to do this. I want to start investing. How do I start investing? Well, some people go with a financial advisor. This is a professional. Okay. This is not me. I am not a financial advisor. This is someone that can specifically tell you, well, these are the investments that you should buy. For your goal, these are the ones that I would advise you to buy. Now, what's the pro? In-person contact, a personal relationship with someone. What's the con? They're very expensive. Also, a lot of times they require large minimums. Many financial advisors require you to have like hundreds of thousands of dollars in order to invest with them. Why? Because they take a percentage of the amount of money that they're managing for you. All right. Not all though. Some financial advisors are much less expensive, and that can be a great option for you. Okay. But you don't have to do a financial advisor. You can also do a Robo Advisor. Okay. A Robo Advisor is a digital platform. And what they do is that you put in your information. For example, Rebecca will go into a Robo Advisor and she'll say, you know what? Like, I don't really know what I'm doing. Like, I kind of understand the investing thing and I kind of understand what Cindy was saying, but like, I just want to get started. And I don't really know exactly which ones to buy. So I'm going to do a Robo Advisor. So the Robo Advisor, they go, Rebecca, how old are you? She puts in her age. How long do you want this money to be invested for? Rebecca's like, you know what? I remember Cindy talking about long-term strategies and really thinking far into the future. So I'm going to do 30 years. Okay, good. All right. Well, these are the investments that we're going to buy for you. How much do you want to invest every month? And Rebecca's like, you know what? I want to do like $200. Okay, great. That's it. All Rebecca does is puts her $200 into this Robo Advisor. She links her bank account to the Robo Advisor platform. They take $200 every month. They take that money and invest it for her. They look at which mutual fund is the best, which index fund they like, which stocks are good, which bonds, how many stocks versus how many. They do everything. They do everything. It's little to no human supervision because it's algorithms, it's computers. Okay. They collect the information that Rebecca gave them about her, and they will pick the investments. Now, what's the pro? It's cheap. It's very, very cheap. Okay. It's accessible. You can do it on your phone. You guys can get started investing in 5 minutes if you felt like it. Literally, you can start investing in like 5 minutes. So easy to do. Low entry to start investing. A lot of these apps, their minimum is either $0 to like $500. Very, very low. So you can get started investing very quickly. For example, Betterment, I think that all you need to start investing with them is like $1. So you can start very low. You don't have to have hundreds of thousands of dollars the way that some financial advisors require. Also, a lot of these apps are very friendly. They're very easy to use. Now, what's the con? The biggest con, honestly, is that you don't have a person that's like necessarily managing for you. Like, you don't have a specific person that you can go to and be like, you know what, Tom, let me tell you what happened with my money last week, right? Like, Tom does not exist there for you. He's not, that's not your financial advisor. But of course, these platforms do have customer service. And I have had to reach out to customer service sometimes when I've had questions. So what I have for you on the screen right now, guys, all right, I want to take a little break just to take a step back and observe what we've done here is these are 4 Robo Advisor companies that I recommend. Okay. I started with Betterment. Okay. I started with Betterment. I still recommend them. I do have a referral code for them, which I'm happy to share with you guys. I think you get like your first, like, I don't know, 3 months managed free or something like that. I also have Elvest. Elvest is a woman-run company. It's specifically catered to women investors. There's also Wealthfront and Wealthsimple. Very excellent platform. Any of them are great, honestly. Like if you decide, I think Wealthsimple's for me, fantastic. If you decide Betterment, great. Okay. I recommend any of these 4. Why? Because they have very low fees, very, very, very low fees. They're very easy to use. Okay. If you guys want a little later, I can show you a sneak peek into my portfolio with Betterment. It's a smaller portfolio that I have, but if you guys would like to do that, I can do that for you later, just so you guys can kind of see what it looks like. And I'm going to tell you guys a little later in a little bit of why I started with Betterment exactly and how much. But again, the reason why I like it is because it's easy. It's because it's easy. And if it's easy, it's for me because I don't have time. I don't have time to be learning so many things. But what if you're like, Cindy, you know what? I want to challenge myself. And I bought some of those books that you recommended, or I received them, right? Because a lot of you received the books because you signed up for the workshop. And so LSU very generously provided to its students, these books that I recommended. And you're like, you know what? Like, I feel confident. I feel like I know what stocks I want to pick. I know what index funds I want to pick. I know where I want to go. Where can I go? How can I buy it? These are some platforms for you here. Okay. You do it with a brokerage firm. What's a brokerage firm? It's a company. Okay. It's a financial company, financial services company, and they're going to purchase and sell the investments for you. They're going to do it. Okay. But you kind of have to tell them how. You have to give them a little bit more guidance. So these platforms, I have both Vanguard and Charles Schwab. These are platforms where you want to have at least, I would say, a little bit of investing knowledge under your belt. Like I think you need to very easily be able to understand what index funds are and the different types of index funds out there. You want to understand what like a target date fund is. You want to understand a little bit more. And you guys you very much can. I would just recommend reading more books, right? Reading a little bit more, educating yourself more. And I absolutely think that you can do both Robo Advisors and a brokerage firm. I actually do that. Okay. I told you guys already, I have Elvest, I have Betterment for my Robo Advisors. And then for my brokerage firms, I have Vanguard and Charles Schwab. Okay. So how did I start investing? Okay. I know, like, look, we spent this whole first part of the presentation talking about the basics, right? Like terms, definitions. What is the stock market? What is investing? What is compound interest? What is a mutual fund? What is a stock? What is an index fund? How do index funds work? Remember, think of index funds as like the cool kids club, right? And they're groups of companies based on different characteristics. I showed you guys one example, the S&P 500. That's one example of a cool kids club. And I also showed you that if you wanted to buy a piece of the cool kids club, you can do so by buying a specific index fund. Okay, so you can do that. But before I had all the knowledge that I'm sharing with you all today, I didn't know anything about investing. I've shared with you in past presentations, I'm the daughter of immigrants. My parents never invested. My parents didn't have the financial education that some people that I went to school with did. And so I had to learn this from scratch. I had to learn this from like day one, like how the heck do I do this? And so because I really had to start with basically nothing, I want to tell you specifically the two things that I did. Number one, I opened up a retirement account with my job. Okay. Again, I opened up a retirement account with my job. When you all graduate from school, you are going to get a bunch of paperwork with your job offers. And you're going to get some forms that are going to say, oh, open up your 401k or your 403b or your 457. And you're going to be like, what the heck is this? And you're going to ignore those papers and you're going to put them away somewhere. That is a big mistake. Guys, please do not do that. Those forms are for investment accounts that are specifically for your retirement. Now, I know you're probably like, well, why would I want to do that, Cindy? I'm like 23 years old. Like, I don't want to think about retirement. I'm not going to retire for like another 40 years. Why do I have to think about investing in a retirement account? Wrong. That whole mentality, all of that, wrong. Because the sooner you start investing, the more money you will have at retirement. Again, the sooner you start investing, the more money you will have at retirement. If you're like, but Cindy, my employer actually doesn't offer one of those. I remember Cindy's talking about like these employers that offer these like plans. Mine doesn't. So does that mean I'm just like, I'm screwed? Like I don't have any other options? No. No, you do have an option. If you guys have a part-time job right now on campus, if you off campus, whatever, you can open up what is called a Roth IRA. Again, you can open up a Roth individual retirement account. And I would highly recommend to do so. Look them up, look up how they work. If you want one that, remember, if you guys want one where it's just like super hands off, where you're just kind of like, you know what, like I know I need to open one up, but like, I'm gonna be real, like I don't want to spend hours and hours looking into exactly what investments I should have. Do a Robo Advisor. If that's you, do a Robo Advisor. Go on betterment.com, open up a Roth IRA. It should take you 10 minutes to do. You have no excuses, do it. If you don't like Betterment, go to Elvest. You don't like Elvest, go to Wealthsimple, go to Wealthfront. Okay, go somewhere. The different options are under the resources page of the workbook. Okay. And if you're like, well, Cindy, I actually feel very confident. I feel like I know which investments I want. I feel like I know what index funds I want to buy. Wonderful. Go to Fidelity, go to Vanguard, or go to Charles Schwab. Why am I recommending those three? They are they're three of the biggest investment companies, very, very reputable. Okay. I only want to recommend companies that have excellent reputations for you guys. Okay. Now, why am I so passionate about this? Okay. Because I'm going to show you guys how, if very simply you start doing this at a young age, you can retire a millionaire. No BS, no nonsense. I'm going to show you the math, but you need to start. Okay. And if you're like, well, Cindy, what if I just want to invest like regularly though? Like, I don't want to do one of these Roth IRA accounts or like the 401k. I don't want to do any of that. Like, why do I have to do that? Taxes. Guys, the reason why the rich get richer, first of all, there's a lot of reasons why. There's privilege, there's disproportionate wealth, there's a lot of things. But a big thing is taxes. The rich know how to manage taxes. And working people, we don't. Nobody ever really taught us how taxes work. So how the heck are we supposed to know? These retirement accounts are actually in the Internal Revenue Code. They are part of, have you guys heard of the IRS, right? The big federal players when it comes to your taxes. In the code, in the legislation, these specific types of accounts are in there. And it's meant to incentivize Americans to save for retirement. You're not really saving for retirement, you're investing for retirement. And they say, well, look, Cindy, if you open up a 401k, you don't got to pay taxes on that money until you take it out. So I get to put that money that I make from my job. Uncle Sam does not touch it. The taxes, nobody touches it. That money that I make from my employer goes bloop into my 401k. It gets to grow tax-free. It's beautiful. And then when I retire, pay attention, when I retire is when I pay taxes. Or maybe you'll do what Rebecca decides to do. Rebecca decides to do a Roth IRA because her employer doesn't offer a 401k. And so what Rebecca does is she opens up a Roth IRA, and that means that she's already paid the taxes on the money, right? Because it's not through her employer. It's through her. It's her pay. She gets her paycheck. She says, you know what? I want to invest this money. She invests the money. She's already paid taxes on it. Guess what? When Rebecca retires and withdraws that money, it's tax-free. So if that money grew to $2 million, congratulations, Rebecca. You put $2 million in your pocket, no taxes. So you pay taxes once. When you open up a retirement account, you pay taxes once. When you open up a regular investment account, you pay taxes twice. That is why, guys, that is why you must open up a retirement account. Whether it's through your job or on your own, open up a retirement account because you will only pay taxes once. Now, is that your only option? No. Because you see, guys, as soon as I opened up my 401k with my job, I was like, all right, good. I'm doing the thing. I opened up the 401k. I filled out all that paperwork. I spoke with the benefits department. I submitted everything. And then I was like, but I want to invest like separately from retirement too. That's when I downloaded Betterment. I downloaded Betterment back in 2018. And I started investing with $50 a paycheck. That's it. Because that's all I could do. I had a lot of debt. For those of you that are not familiar with my story, I graduated law school with $215,000 of debt. I didn't have a ton of money to be investing. So I started investing $50 a paycheck. So Betterment would basically, they would just pull out every other week, which is how I got paid. They'd pull out $50. And they did everything. Like I just filled out like my name. I linked my bank account. I told them I want to do $50 a paycheck. Boom, they did everything for me. They picked the investments. They did all of it. Okay. And that's how I started. But little by little, of course, as the years have gone by, I started doing then $100, $150, a little bit more. Why? Because now I can. Okay. So again, let's keep it simple. Cindy, how do I start investing? Number one, open up a retirement account. Start investing. And remember, it can't just be that you want to open up a retirement account and then you just kind of leave it alone. No, you have to make sure, is your money being invested? For example, I have Charles Schwab. Charles Schwab picks the investments for me. They do everything. So I know that they're investing my money. So that's good. Make sure your money is being invested. Okay. So number one, retirement account. And number two, if you want to keep it very simple, very basic, I like a Robo Advisor just because it's going to, at the very least, it's going to get you comfortable with what investing looks like. Obviously now, guys, I have many other investments, especially because I paid off all of my debt. I invest a lot of my money, but I started with $50 and a Robo Advisor. I also started small. So we're going to talk about starting small. Okay. So we're going to go like maybe another 5 minutes before we start diving into like examples, and we're going to calculate this together, because that investing, you need to work. You can't just, investing isn't the kind of thing that you can just like listen to it and be like, yeah, I'm going to be a great investor. No, you need to do, you need to act. Okay. And so I want to show you all the power of time. Because remember when I told you guys earlier that like, it's really about starting now. It's not about, oh, but Cindy, I just don't make enough money to invest. Oh, but Cindy, I'm just so young. Oh, but Cindy, like, no. One of the things that I wish I would have done, I started investing when I was 28 years old. I wish I would have started at 18. I really wish I would have started when I was a kid, because I've been working since I was 16 years old, but that's fine. I wish I would have started when I was 18 years old, but I didn't. I started a whole decade later. I started at age 28. It's all right. I started. I could have spent my time being like, oh my gosh, I can't believe I didn't start earlier. I would have made so much more money, right? No, don't beat yourself up. Don't beat yourself up. Just start now. Okay. I want all of you to have a 2021 goal to start investing, because that is how important it is. It is important for generational wealth. It is important for our legacies. It is important as people of color. It is extremely important to start investing. So I want to show you all how investing $5 a day can grow. What if you could invest $5 a day? And I'm not saying, oh, you need to give up your Starbucks or you need to give up. No. I'm not saying that, right? I'm saying, what if you could make $5 a day of investing a part of your budget? So what's $5 a day actually, right? $5 a day times 30 days. Who's good at math here, right? It's what, like 150 or something, right? Let me do a math check, guys. Yeah. Okay. So $150 a month. Not too bad, right? Not too bad. $5 a day. If you invested that money for 10 years, guys, 10 years, let's look at the bottom. You would have $27,000 at the end of 10 years. Just $5 a day. That's it. $35 a week. What if you did this for 20 years? you would have $86,500 at the end of 20 years. Again, $5 a day. What about the end of 30 years? You'd have $214,000. You guys are starting to see compound interest working, right? Because we jumped from year 10 to year 20 to year 30 at $214,000. If we just add another 10 years, 40 years, you'd have $500,000. $500,000 at the end of 40 years. But see, nobody likes this slide because everybody's like, Cindy, I don't have 40 years. Like, I don't know if I'm going to be alive in 10 years. Like, I want to get rich tomorrow. But you see, my friends, wealth takes time. And if everyone was doing this, we would know a bunch of millionaires. But how many millionaires do you guys know? I don't know a lot. I mean, well, now I know a lot because of my profession, right? Because I'm a corporate attorney. But when I was 25, I didn't know any millionaires personally. I didn't. Wealth is hard. And it's hard because people don't understand how to grow it. It's not hard because it's actually hard. Because you see, if somebody invests $5 a day for 40 years, which is very doable, it's $150 a month, they'd have $500,000. But let's push it. Because you see, I've had talks with clients that are recent college graduates. I haven't done coaching since last year, but this is something that when I was having my coaching, I would coach college graduates on, investing, on retirement, on just what they could do, right, with their money. And I want to show you guys how a 22-year-old first generation child of immigrants, not making a six-figure job, income or anything like that. I want to show you how they'll retire a millionaire. Pay attention. Here's the path to $1 million. The average age of retirement, let's walk through it. The goal is $1 million. How do we get there? They are 22 years old. The average age of retirement in the United States is 65. So that means they have 43 years to invest. Let's go to the next line. Amount of initial investment, $0. They don't have any money. They literally just got a job. They had nothing in savings. They had no money. Nobody has given them money. They don't have a trust fund. Their parents are, like I said, they're immigrants. They're hardworking. They were not able to give their child money like that. So they have $0. That's okay, because we're still going to become a millionaire. They decided to invest this passively. So remember what I taught you guys earlier, right? Rate of return, compound interest. What is that number? On average, the stock market performs anywhere from 7 to 12%. Remember, Cindy does not use 12%. I don't even like using 10%. I know a lot of people do. I don't even like using that because I am very conservative. Let's just pretend that she put her money in for 43 years and she just accepted average returns, the most average at 8%. And what she did was invested $250 a month. You know what people blow $250 a month on? Nonsense, okay? But she says, you know what? I'm gonna put me first. And from now on, from the age of 22 until the age of retirement, all I'm gonna commit to do, notice guys, all she's committing to is $250 a year. I'm sorry, $250 a month, okay? $250 times 12 months is $3,000 a year. That's it, just $3,000 a year from now until the rest of her life. Even when she gets pay increases, even when she gets bonuses, we're gonna do the bare minimum. She's only gonna do $250 a month. If she does that, look at the bottom, she'll retire with over $1 million. That's how you become a millionaire. Now, I want you all to think about this. And I want you to write in the chat if you would like to. I want you to try to convince me why you shouldn't retire a millionaire. Try to convince me. Why should you not retire a millionaire? It's really hard to. I'm also a lawyer, so it's really difficult. It's really difficult to argue with a lawyer. But I want you to think about it. You can retire a millionaire. You can. I just showed it to you. What more do I need to show you? But you need to act. You need to act, because investing is about action. If you don't act now, if you just let time wait and you're like, oh, I'll do it when I'm like 30, like, Cindy, come on, like, stop, right? Well, you're not going to retire with $1 million then. Maybe you could, but you would just have to invest more. You absolutely could. I've had clients that come to me when they're 40, 50 even, and they're like, Cindy, like, I'm behind. But when you start when you're young, you have that leg up. So please start when you're young, okay? And again, these are the 3 books that I recommended. They're in the resource tab, okay? I want you to read these books, guys. Read them. They're excellent, excellent books, okay? This last one, The Simple Path to Wealth, if you're like, you know what, I just want, like, what is the simplest investment that I could buy? The simplest one. And the one that can lead me to financial independence, that this book is for that. Like, I love this book. I would read this book again. I think it's an amazing book. I love these 2 books as well. These 2 books are very good, kind of like step 1 books, right? Like your step 1, read one of these 2, Broke Millennial or Grow Your Money. Both of the authors are actually my friends, and they're incredible. I've read the books. Really good. I'm actually in the Grow Your Money book. I'm featured in that one. I recommend both of them though. They're wonderful. But if after you're done with one of these and you want to take it to just level 2, I would read The Simple Path to Wealth, because it's actually such a helpful book. I found it really helpful. Okay. So that's the presentation. You know, I wanted to stick to an hour, which I did. I want us to go through your workbook. And I want us to run some numbers. I want us to run some calculations. The Q&A is supposed to technically be for the last half an hour, but if you have questions now, start writing them in the chat so we can start going through them, okay? Because what I want to do is model different scenarios for you guys, okay? So let's do that. I'm going to pull up another screen here and share it with you guys. I'm going to pull up the investing calculator that I was using, okay? So first, let's go to hold on one second. All right, 1 second. All right, so what I want you guys to do is go to resources, okay, in that tab, and I want you all to click on the bank rate investment calculator. Let's click on that, okay? Let's click on that together. So I just clicked on that. Can you guys see the investment calculator on my screen? Did that come up? Excellent. Okay, good. So, all right. So this is the last one that we went through, right? We went through the example of that young woman, right? Actually, this isn't the last one. This is one where it was higher, right? So let's change this to the young woman that comes to me and says, Cindy, I want to do $250 a month. I want you all to click on that calculator, and I want you all to replicate these numbers. So click on the calculator and start plugging in these numbers, okay? So the first one up top, what's your goal? $1 million. Click on, put that there, okay? Next one, I want you to take the number 65, okay? That is the average age of retirement in America. And I want you to subtract your age. So if you're 20, okay, that number should be 45. If you're 22, it should be 43. If you're 30, it should be 35. So subtract 65 from your age right now. Okay, that's the number that should be there. I'll put my age. Okay, how about we do that? I'll put my age. So I am 30, I'm turning 32 actually in 20 days. I'm gonna put 33. Okay.
Where can I find this link?
So right here, when we go to investment calculator, check it out. In the resource tab, that bank rate investment calculator, okay, click on that. And that'll take you to where we're going, okay? And remember, the top, we want to use $1 million, okay? So were you able to find the calculator okay? No? You know what, guys? I'm going to shoot it in the chat. All right, I'll put it in the chat. Hold on. How do I get the chat? Here we go. I lost the chat there, guys. All right. So I just included the calculator in the chat, so you guys can pull it from there. Okay. So the goal is $1 million. So we're gonna figure out, like, what do we need to do to get to $1 million? Now, I want you guys to pay attention to something, right? Because so actually let me just take a step back. So here, remember, we put the age, right? So 65 minus your age, amount of initial investment. Now, here's where it can get interesting. You can put 0 if you're like Cindy, I have like no money, right? Or you're like Cindy, well, from your workshop last time, you taught me the importance of an emergency fund. So I have like $2,000 in an emergency fund separately. Remember, we do not invest our emergency fund. That's a no. We do not do that. Our emergency fund is number 1. It is separate. We pretend it doesn't exist. This is amount of initial investment. Now, if you say, well, Cindy, I actually have $100 I can start investing with. Perfect. Put $100 there. If you're like, Cindy, I don't have anything, put 0. And that's okay. I started with 0. Actually, I started with $50. That's how much I started with. But you can put 0. Next, rate of return on investment, we're going to put 8. So make sure, everyone, that number is 8. Remember, average. Next one here is how much you want to start investing every month. That's going to be dependent on everyone. I don't know each of your individual stories. Some of you, it might be $20 to start with. Some of you, it might be 100. Some of you, it might be 500. Whatever the number is, guys, put that number in. The contribution frequency, put per month, right? This is, remember, we want to try to make this a monthly habit. We don't want to just invest once a year. We want to try to make it regular part of our healthy habit. The same way that you pay your cell phone bill, you pay your rent, I want you to invest regularly. The compound interest, just put compounds annually and then hit calculate. What I want all of you to observe very, very carefully is, you see in my example that I gave you guys in the presentation of the 22-year-old, if she does $250 a month, look at how much she ends with, over $1 million. Remember, I showed you guys that. I showed you the math on that. But what if she waited 10 years, guys? What if she just waited 10 years? What if she waited until she was my age? Look at what happens, guys. Look at what happens when I change this from 43 years to invest to 33 years to invest. Look at what happens to this number down here. We go from $1 million, a little over $1 million, to less than $500,000. That's just if you wait 10 years. What if you waited until you were 42? $189,000. So you investing, if you're 22, you investing $250 a month will make you a millionaire. A 42-year-old investing $250 a month, they'll have less than $200,000 at retirement. Do you guys now understand why I am so passionate and so emphasizing that you must start now? You must start when you're young, because compound interest, that beautiful, magical concept, it needs time to grow. It needs time. That's how investing works. A lot of people, they want to get rich quick. They're like, Cindy, no, I don't want to do any of this. Like, I want to just get rich tomorrow. So do I. So do I. It's hard though. It's hard. And a lot of times people lose a lot when they try to get rich quickly. Okay. So let's go through each tab of your workbook, because I want you guys, even if you don't do it today with me, I want you guys to start thinking about this, because look, there's a reason why you decided to participate in the workshop today, right? It's because you want to build wealth. In order to do it, you need to do a little bit of work. Okay. So let's go through this workbook one by one. We'll do this for about like maybe another 15 minutes, and then we'll dedicate the last half an hour to Q&A because I want to strictly dedicate that time to question and answer. All right. So here on this first tab, we have questions that I want you to ask yourself before you start investing. Again, this is a little checklist, if you want to call it that, on the questions that I would like you to ask yourselves before you start investing. The first one is, do you have a budget? You knew it was coming. You need a budget. You need a budget. If you're, and your answer should be yes, because we've already done this, right, guys? Like I gave you the template for the zero-based budget. You just need, all you need to do is plug in your numbers, super easy. It could not be easier for you, right? So do you have a budget? Now, of course, we want to answer yes. Okay, beautiful. Next, do you have an emergency fund? We need to have an emergency fund. Why? Well, because guys, what if an emergency happens? If an emergency happens, you don't want to be pulling money out of your investments. Every time you take money out of your investments, you have to pay taxes. And depending on when you take it out is depending how much money you have to pay back in taxes. You can't just like take your money out of the stock market and then go and spend it. That's not how it works. The government will always get their money. And so every time you sell investments, you have to pay taxes on that. So investing is not an emergency fund. Your money that's invested is not your emergency fund. You need to have your own emergency fund. And so the answer to this question is yes. You're like, Cindy, I do. I have like, I paid attention to your workshop. I got the workbook. I did the math. You asked me to plug in the numbers in the worksheet, and my number was $2,000 for an emergency fund. And I did that, and I have that. Congratulations. Put yes. Is your emergency fund currently part of your budget? Now, let's say your emergency fund number is $3,000, but you have $2,500. So you're putting $100 every month into your emergency fund budget. That's good. That means you have a plan. Remember, guys, what the budget is. The budget is a plan. That's all it is. Now, do you have a debt payoff plan? Because you see, guys, if you have credit card debt, right? We're going to need to talk about that. We talked about how to create a debt payoff plan. I gave you the template. We went through it by detail. So yes, you do have a plan, but do you have high interest debt? If the answer is yes, if you have credit card debt, I want you to focus on paying that off. Why? Credit card debt usually has high interest in the range of, let's say, 15 to 25%, 29%. If you guys are trying to pay off a credit card that has 20% interest, and you're also investing, but your investments are making like a 10% return. Remember, we talked about that, right? 7 to 12%. Let's pretend is doing really well. Let's pretend it's doing 12%. So you're getting 12% here, but you're paying 20% here. I want you to focus on paying off the high interest debt. It doesn't mean you have to be debt free in order to invest. I wasn't. I had debt when I was investing, but I had student debt. I have student loans. My student loans were about 4.5, a little less than 4.5%. So there it made sense. I didn't have any more credit card debt when I was investing. That's the only exception then that I would say is that if you have credit card debt, I would like to see you pay that off, ideally. Okay. So you say, yes, you paid off all your high interest debt. And did you read at least one book on investing? Because look, this 1 hour, this 2-hour workshop is not, this is just the start. You're just scratching the surface. Okay. So your answer is yes here. You're like, yes, Cindy, I read the Clever Girl Finance book, or I read the Broke Millennial book. Fantastic. Okay. Now that we did that, okay, we can start creating an investing goal. Okay. So let's pretend that, let's pretend you have big goals and you're like, Cindy, I am ready. I'm going to commit. I am going to be a multimillionaire. So Cindy, I want to know what it's going to take for me to reach $2 million. I'm like, okay, so let's go to the calculator. We have to go back to the calculator. You put in $2 million. Okay. Let's pretend you're 22 years old. And let's pretend that you have $5,000 that you can start investing with. These are just fake numbers, right, guys? But I just want to show you what the process is. You have $5,000 to start investing, and you're like, well, you know what? I want to invest, let's say $600 a month. Does that get me there? Oh, I put the wrong age. There we go. Okay. Well, $600 definitely gets you there. You don't need to go that high, is what it's telling me. You can go with, let's say, 460. See? You just mess around with the numbers. Play around with the calculator. Just play around with it. That's what the calculator is there for. So when you do this, okay, look at this. Look at what's on this calculator. All right? So what's on this calculator is your big goal. Okay, let's just pretend. Let's pretend that Rebecca has a major goal of doing $2 million. Well, she put in the numbers, and the numbers tell her she needs to invest $460 a month. So all you do is you go back here and fill it out. Fill out this template. Fill it out. It's very powerful when you're filling this out, when you're actually writing down your plan. Okay. And of course, I want you all to put this in your budget. Remember, your investing goals, they're part of your budget. They're part of your money plan. So put it in there. What you would do is, let's pretend you decide to put, let's say, $100 in emergency fund. And your Roth IRA, you decide to do $200. And the Roth IRA, you opened one up. And then you also opened up a Robo Advisor account. So you're going to do like $50. Boom. Put it in the budget. Make sure it is part of your money plan. Okay. Make sure it's part of the money plan. Let me clear this out now. I'm going to clear these out in case anyone else wants to make copies of the spreadsheet. So let me just. Okay. And then the last thing, all right, after we put it in the budget, is the resource tab. And the resource tab is gonna, look, if you wanna, you remember a word that I said and you don't really remember what it means, or somebody uses a certain investing word, you wanna find out what it means, go here, okay? Go to Investing Basics. Investor.gov has excellent resources. Investopedia, excellent resources. You wanna calculate how much you would have in, how much you need to invest, or what you need to do, or whatever it is, go to the calculators. That's there. Then I also have here brokerage companies and robo advisors. So these are some of the ones that I personally love because I use them. The Betterment one is my affiliate link in case you're interested. No pressure at all though. Like I said, the four that I recommended, Betterment, Elvest, Wealthfront, and Wealthsimple, are all really, really good. Okay. And I'll actually link Wealthsimple and Wealthfront in the chat for you guys, because I forgot to include it on this resource tab here. So let's do that. Let's do that now. Let's do Wealthfront. All right. So Wealthfront is an option here. All right, I just put it in the chat. Check that one out. And then there's another one called Wealthsimple. All right, Wealthsimple is another one that we really like. All right, you can check those, do your research, see which one goes best with you and your goals. And then down here, of course, I have investing books that I recommend. Okay, so with that said, that's the presentation. Okay, it's a lot of information. I understand that. But I think the reason why I wanted to walk you through the calculators and just take that time with you is because investing requires you to act. Like if you guys just take this information today and you're like, oh, that was great. That was a great presentation. and you don't decide to open up an investment account until you're 32, until you're 42, until you're 52, it's like, then this wasn't effective, right? The goal is to empower you so that you can take action and actually open up an account, start investing, start reading, start educating yourself more. Okay. So with that said, all right, with that said, I want to now leave the floor for questions. I think I left enough. Yeah, perfect. 35 minutes we have for Q&A. I want you guys to ask me your questions. If you feel a little shy about asking it, feel free to, you can just private message it to me. You can turn off your camera if you would like to. If you don't want to, that's okay as well. I'm pretty friendly here, so no worries either way. And yeah, I want to thank you all for giving me this opportunity to present to you all on investing. I hope you understand why investing is so, so important now, and how it really is the key to growing your money. Okay, so with that, I leave the floor open to all of you. Okay, so we have Maricela has a question. Go for it.
Hi. It's a question from my husband.
Yes.
Yeah, we're both listening and loving it. But I recently started investing in cryptocurrency, and I got in on Deutsche before it took off a little bit. I was just curious how you feel about cryptocurrencies going forward and if they're worthy investment.
Yeah, so that's a great question. You know, cryptocurrency is, so for those of you that might not know, cryptocurrency is a different type of currency, that it's a digital currency that has come up in recent years. You may have heard of Bitcoin is a very popular one. And what it basically is the goal with cryptocurrency is to not necessarily have that government control over money the way that we currently do in our society, right? So for example, if I show you a dollar bill and I give you the dollar bill, you are confident that you can go ahead and purchase something because that dollar has value, right? If you go internationally with a $20 bill and you want to exchange it, they will take your $20 bill because they trust it, right? It's American money. It is a dollar bill. It is backed up. There's that trust. However, a big part of that is the government. That's the reason why it works. It's the trust in our government. Cryptocurrency is an alternative type of currency where you can also buy things with it. You can. It's valid currency, but the way it functions is different. It's not backed up necessarily by the way, you know, the same way that like a dollar bill is, for example. And what it is that there's something called a ledger, basically, which is this, think of it as like this massive Excel sheet, okay? And that ledger records the transactions that's made with this cryptocurrency. There are different types of cryptocurrencies. There's Bitcoin, there's Dogecoin, there's Ethereum. There's so many different types of cryptocurrencies. And right now it's the hot item. Why? Because it's new, it's exciting, right? Because of that, I personally do not invest in it. Will I? Maybe. It's something I've spoken about with my husband, right? My husband and I, we've talked about it. Like, you know, what's really funny is that when I started law school, there was this guy that was talking about Bitcoin. And I was like, what the heck is this guy talking about? He was like, yeah, you know, I just bought like $1,000 of this thing called Bitcoin. And he was trying to explain it to me. And I was like, this makes no sense. Like, this is so dumb. Like, why would anyone do this? That guy probably has a lot of money right now. Okay. I'm sure he has a lot of money because this was back in 2013 or 2014. I think it was 2013. Okay. And I had never heard of Bitcoin before. And now it's way more than just Bitcoins. There's other ones as well. So now your question is two parts, right? It's one, how do I feel about it? how Cindy personally feels about it is that it's very risky. It's very risky. It's exciting. That's why the volatility is extreme. I mean, one day it'll skyrocket. Like, let's look at it together, guys. Let's look at it together. Let's look at specifically the currency that you told me about right now, Dogecoin. And I never know like what's the correct, pronunciation of it, but let's just go with that one. So let's go to, I'm going to pull it up here. Let me share my screen. Okay. All right. So as you all can see, right, let's take a look at this graph. Let's look at how it's performed in 1 month, just 1 month, 1 month. Okay. Look at the value of it back in April 4th. Look at the value of it, 0.05. Okay. 0.05. Look at the value just a couple, not even 2 weeks later, 0.3. Look at how it skyrocketed. And then look at how it plummeted in April 22nd. And then look at where it is now. It's at its highest, 0.4. The thing is that no one knows how it's going to perform. It's very volatile. It's very risky. If you look at Bitcoin, you look at Ethereum, you look at all these different types of currencies, they're exciting, but they are volatile, which means that if you, Maricela and husband, if you bought your Dogecoin here at its lowest, oh, fantastic. If you bought it up here, you bought it kind of expensive, but no one knows. No one can possibly know, because that's just how the market performs. It's very unpredictable, especially with cryptocurrency. Because I'm a very conservative investor, I don't know that I have the stomach to withstand that. So my husband and I have spoken about it, because my husband's been like, we should have bought Bitcoin like before, and I tell him, maybe we can make it part of our portfolio. But maybe what we'll do is include it as about maybe like 5% of our portfolio. So let's say you have $100 to invest. I would invest $5 in that, in a cryptocurrency. Why? Because what if you lose all of it? What if you lose everything? Which is very possible with the cryptocurrency, very, very possible. Well, then you only lost 5% of your portfolio. It doesn't hurt you as much. But if all of your investments are cryptocurrency, if you're 100% in, if you're 50% in, will losing 50% of your entire portfolio hurt you? It would hurt me as hell. I would cry, okay? So with that said, will I invest in it? Maybe sometime this year I'll I want to read a little bit more about it. I want to educate myself a little bit more. Maybe I will. But how much of my portfolio am I willing to put up to it? Because of how I am, probably no more than 5%, no more. Other people I hear have done 10%. I personally don't think I would go that high. But look, if for some reason it does go really high and the value of your investment skyrockets, then that's awesome, right? I mean, you made a good guess. But that's kind of what it is. It's a guess. And the reason why it's so volatile, guys, is because, again, remember that trust that I was telling you in the US dollar, that type of currency, that trust has been around for centuries. Cryptocurrency is very new. And that's why it's volatile. It's because people just don't really know it. People don't really understand it. The technology is a little complicated as well. But again, if you struck gold and you bought it really low, like if you bought it back in April 4th and you have it today and you bought let's say you bought like $5,000, and are you kidding me? You probably have like tens of thousands of dollars, if not like $1 million, because of how much it's increased. And so then the temptation is, well, should I sell? Of course, I can't give the answer to that. I'm not a financial advisor. What I will say is that you will have to pay taxes on it. So please be mindful. If you do choose to sell any of your cryptocurrencies, please be very, very mindful of the tax implications. And also, I would also follow developments in the news on the government regulations on cryptocurrencies. Because right now there are some, but not that many, but that's something that the government wants to do more of because they're seeing that a lot of people are investing in this. So I hope that kind of answers your questions. It was kind of long-winded, but I hope that was a little helpful.
Loved it. It was really helpful. Thank you. And we did get in at a good time. We actually got in January. So I think it was like
as like a joke, like, hey,
yeah, it was such a minimal amount too. Just kind of like, oh, whatever. It's like less than 4 cents.
So brilliant, because the person that got in at the height did not get the value that you did.
No.
So like if you got it in January, I mean, January, it was like a penny, or it was like,
yeah,
like lower than that. It was like a fractional, so now it's multiplied. So, if I was in your situation, like if my friend told me, Cindy, this is my situation right now, I would say it's going to be up to you whether you feel that this is it. If you feel that this is it, the height, then you would want to sell, of course. But if you feel like, no, like I think we have some way to go, well, then you would want to hold on to it. Either way, though, you want to make sure that you understand the tax implications. Specifically short-term capital gains tax is what you would have to pay, and just follow the news, right? Like follow what's going on with it. It's something that is exciting. Bitcoin, for example, it went down, I think 5% over the past day or so. But just a month ago, it had skyrocketed. And people were like, oh, no, it's going to continue to go more, definitely. Well, expect volatility though, right? Expect volatility. So that's what I would do. I would just make sure that you have, if you were, I like talking to people the way that if they were my friends, I would say, just make sure you have some balance, right? Make sure you're not just all in on one type of investment. Make sure you have some balance as well. But yeah, look, hey, you got it in January. I wish I did.
I wish about more.
Thank you.
I'm just waiting for Jeff Bezos to start accepting it, and then I'll see where it goes from there.
That's another thing, everyone, with cryptocurrency. You might have seen, guys, right? You might have seen a lot of these, let's just be real and call them what they are. These bot accounts on social media, right? And they're like, oh, you need to buy this. Why are they doing that? Well, it's not just, some people are like, oh, well, they're scammers. Well, some of them are scammers, right? But the reason why they're doing that, and there's a lot of this pressure on people buy these types of currencies, buy them, is because they want people to buy them. Because the more people buy them, the more trust is in the currency. That's why. Because when there's trust, that means more stores will accept it, more vendors will accept that. All of a sudden, we're starting to look at something that's closer to the American dollar than just some vague digital currency. So all of this comes down to, if I had to give you one word on what all of this comes down to with all of the cryptocurrencies, it's trust. If there's trust in a currency, it's going to increase in value. The second people start doubting it, it'll plummet. So that's what it'll come down to. And a lot of it's psychology. So yeah, excellent question though. Excellent question. I'm sure somebody else had a question like that and maybe they were a little too nervous to ask. So happy you guys did.
Thank you again. Appreciate it.
You're very welcome. All right. Anyone else? Anyone else?
So you said that the money that you invest is not taxed until your retirement.
My retirement accounts, yes. Just my investments in my retirement accounts. My other regular ones, no. Those I get hit with taxes twice.
Okay. So if you put money into say the Robo Advisor, that does get taxed?
Okay. So the Robo Advisor, a good Robo Advisor would offer you the option of a Roth IRA. If you do a Roth IRA or an IRA, you only get taxed once. And you can do that with a Robo Advisor. However, I don't have the individual retirement accounts. Those accounts that I was telling you guys, like the Roth IRA or the IRA, I don't have one of those. I only have a 401k with my job. That's a completely separate one. So the account that I have with the Robo Advisor, technically, I would get taxed twice. I got taxed once already, which was in my paycheck, right? Like, you know, when you see your paycheck, like the amount is not what you actually are supposed to get from your gross pay, right? Because the government, they're the first ones in on your money. So technically, I already pay taxes on that money. So I've already been taxed once. All right, great. I take that money from my paycheck and I deposit it into my Robo Advisor. It's growing, it's doing its thing. If I decide, Alondra, if I decide 2 years from now, I want to pull that money out because I want to put it towards a down payment on a house, I will have to pay what is called capital gains tax. That is a tax that the government takes on the profit that I made, not on the original money that I put in, Alondra.
Okay.
If I put in like $5,000, that money does not, it is not taxed. But if I gained $3,000, the government will tax the $3,000. Okay?
Okay. Yeah, that makes sense. All right. Thank you.
Yeah, of course. All right. Anyone else? Don't be shy, guys. I know this is a lot. Investing is a lot. When I was first learning it, I was like, but little by little.
Wait, I have a question. So then I'm a little confused on, like, if you were to invest, right? The only, or not the only place, but if one of the places you did it was the Roth IRA, like, but that's like only an investment fund, right? I mean, that's only a retirement fund, right?
Yes, yes.
So then if you wanted that and then somewhere else, because obviously the retirement fund, you want to take it out like
Years from now.
yeah, years from now. Like, what about another long-term one that is like not?
Yeah.
a
Oh, you
retirement-
can leave your money in for as long as you'd like. You know, like you don't have to, like if you have like a regular account, for example, like just a regular old account with, let's say, Betterment, you don't have to take out your money in 10 years, in 20 years, or, you know, and it doesn't have to be a retirement account. You can kind of just let it chill. You can just let it grow. It does not mean at all that you need to take it out. But you absolutely could if you wanted to. So it's really going to depend on you, you know, and your style, and also what your goal is. You know, it's really going to depend on your goal. So that's what I would very much recommend, is for you to think about, what kind of goal do you have? You know, what kind of goal do you have? Let me say something really quick. All right, hold on one second. I'm gonna show you guys something really quick.
And like something else regarding the Roth IRA. So is there like a, I think I remember you saying that there's like a cap on that. So
Yes.
does that
yes.
mean that you would only be able to like I'm just confused about that too. So you wouldn't be able to invest like more than the cap, right? Like, let's say, yeah, eventually, let's say you start with 0, but then eventually, like over the years, like your income grows, so you add more.
Yeah, the Roth, the cap is $6,000 a year.
Okay.
It's $6,000 a year. So I want to show you guys something really quick. Let me just share my screen. 1 second. So let's take you, for example. Rebecca, how old are you?
22.
Oh, beautiful. You are my example here. Okay. Let's say you graduate from college and you're like, I want to max out the Roth IRA. Like I'm committed. That is the only investment you're interested in for whatever reason. You are just like, I want to optimize my tax situation. Like I want to think like the rich. And so you invest $500 a month. Why? Because that's all you can, right? With the Roth IRA, it's not that you have to do it every month. You could do it once a year. You could just literally once a year deposit $6,000, right? But you decide to space it out. You decide to space it out. You do, your initial investment is $0 and your monthly is $500 in the Roth IRA. At the age of retirement, Rebecca, you would have over $2 million. So if you open up your Roth IRA at the age of 22, okay, and you decide that you're going to max that out from now until you retire, you will have over $2 million in that account. And when you take that money out, it's tax-free. You don't pay taxes on it. And that's why I like the Roth IRA, because instead, Rebecca, what if you were like, I don't really want to do the Roth IRA. I'm going to just do a regular investment account. There's nothing wrong with that, but you're going to have to pay taxes on the $2 million. And remember, how do the rich get richer? One of the things that they do is that they know how to do taxes. They know taxes. Okay. So that's the reason why I would highly recommend. Okay. Highly recommend making sure you do the research there. But what if, aside from that, let's say you have your Roth IRA goal, which is great. What if you say, you know what, I want to save for a down payment on a house, but I don't want to buy a house anytime soon, Cindy. Like, I live in California, houses are expensive. I want to buy a house in 10 years. I want to buy a house when I'm your age, Cindy, when I'm 32. Okay, so I have 10 years to invest. Let's say your down payment goal is, I don't know, let's pretend it's $50,000, right? Let's just pretend. So you want to save $50,000 in 10 years. Like, that's your goal. Okay. Well, then how much should you be investing in your, let's say, LVEST account? Okay. Well, it should be about, you play around with the numbers. You do exactly what I'm doing right now, because I don't know these numbers from the top of my head. Okay. 280. That's how much you need. Okay. So if you want to save a $50,000, if you want to have a $50,000 down payment in 10 years, when you're my age and you want to buy a house, that means that you would need to invest $280 a month. And then when you do, you can do that. You can, let's say, for example, LVEST and Betterment, they both have these like goals. Like, you can set goals and you set the year and all that, right? And it'll tell you if you're on track. It'll tell you like you're on track to meet your goal and whatever. And so, and that's great, because then you can know if you're, remember, they're a Robo Advisor. That's their job. Their job is to make sure that they're keeping you on track to your goals. And they'll tell you, yeah, you're on track. Good job. Go ahead. Keep on doing it. Keep on doing it. And then, for example, if you just did $250 a year, they might tell you, you're a little short off your goal. They might say something like, if you invest $30 more, you are likely to hit your goal, So again, the power of investing is that if you do $280 a month for 10 years, it would grow to $50,000. If you just put it in your mattress, if you didn't invest that money, if you just kind of just like put that away, how much would that be? $280 times 120 months, $33,000. So you could hide money in your mattress and it'll go up to $33,000. Cool. Or you can invest it and have $50,000.
And then I have like a quick question about the emergency fund that like you explained another workshop ago. Mm-hmm. So for the emergency fund, did you say that you recommended to have like whether it's like 3 or 6 months or whatever of expenses, would you recommend to have that like in cash, or like half in cash and then half like in an account? Or because I know like emergency funds sometimes like cash is more accessible, or depending. Yeah, so that's my question.
So I think that's a great question. So for me personally, I have basically my entire emergency fund in a high yield savings account. So it's a savings account that, look, the interest rate is crap. It's not a lot, right? Like it's whatever, but it's liquid, right? It's in a bank account. It's not invested. However, I personally keep $1,000 in my Chase bank account as well, because I have an ATM like literally like 2 blocks away from me, that I could just pull money really quickly if I needed it. I typically don't carry cash at all. Like, I think now I have I think I maybe have like $200 of cash in my apartment, right now. Some people feel more comfortable with like $500. I just don't usually, especially because of the pandemic, I don't really use cash at all. So that's the only reason why I don't really keep it. But I do like to have at least $1,000 in my Chase savings account, just in case I'm like, oh my gosh, something happened, or like, mommy papi needs some money or whatever. I'll just like run to the ATM, pull out, $100, $300, whatever it is. And of course, like if it's a larger emergency, those are a lot rarer, right? To have like an emergency that's above $1,000, it's usually like, God forbid, like a medical emergency, a job loss, or like, something a little bit more dramatic, that it's okay if my high yield savings account takes like a business day to transfer it, because it's not something I need like in that second. So that's kind of what the emergency fund, like when it comes to like my strategy for what bank account and all that, I basically keep all of it in my Barclays bank account. I keep like $1,000 in my Chase savings account because I have the ATM right here. And I have like $200 maybe in cash here. So yeah.
Okay, thank you.
Good question. All right. Well, I think that's it. I mean, unless anyone